There is a saying in the intelligence community, the loudest threats are rarely the most dangerous. It is the quiet ones you need to fear. In financial markets, we are conditioned to look for noise. We look for the massive green candle that shoots to the moon. We look for the violent red crash. But right now, if you look at the silver chart in the low 60s, you see something strange. You see nothing. The price is stuck. It churns, it dips a few cents, then stops. To the average trader, this looks like boredom. It looks like the rally has stalled. But if you peel back the price and look at the volume, you see a completely different story. You see a war zone. Over the last 48 hours, billions of dollars of paper shorts have been thrown at this market. Banks have shorted, algorithms have dumped, and yet the price refuses to break. Why? Because someone is standing there, someone massive, someone with pockets deeper than the banks. We are witnessing the arrival of a mega whale who has placed a limit buy order so large it is absorbing the entire global supply without flinching. We estimate this single entity has bought $650 million in silver in 2 days. This isn't a trade. This is a takeover. Here is how they are doing it without spiking the price. It is called an Iceberg Order. If you want to buy 10 million ounces, you can't just hit buy. The price would jump to $100 instantly. So, you use an algorithm. You place a visible order for just 5 contracts, but hidden in the dark pool is an order for 50,000. Every time a seller hits the 5 contracts, the computer instantly reloads them. Sell 5, reload 5, sell 5, reload 5. The price stays pinned. But the volume meter spins like a turbine. This is exactly what is happening at $63. Every time the banks try to smash the price, they hit an invisible concrete floor. That floor is the whale's mouth opening. They are draining the swamp. They are taking the nervous shares from the weak hands and transferring them to the strong hands, who has $650 million in cash and needs physical metal to survive. It isn't a hedge fund. It isn't a bank. It is a strategic corporate entity. We are watching the accumulation phase of the century, and the longer the price stays flat, the bigger the explosion when the whale is finally full. This is the investigation Wall Street doesn't want you to see. They want you bored. They want you selling. We are racing to hit 1,000 subscribers to break the shadow ban and expose the identity of this buyer. If you want to be on the side of the whale, not the plankton, subscribe now. The hunt begins. But how do we know this isn't just the banks covering their shorts? This is the most common question I get. Isn't this just JP Morgan closing their position? It is a fair question, but the forensic data says no. We have analyzed the footprint of this buyer, and it looks nothing like a bank. Here is the evidence. Evidence A, the time of day. Bank buying is usually volatile. It happens during fixing hours in London or right at the market close. But this buying is constant. It is happening in the Asian session. It is happening in the European morning. It is happening in the US pre-market. This is algorithmic accumulation designed to minimize impact, not a panic trader covering a margin call. Evidence B, the physical premiums. If this were just paper short covering, the spread between the paper price and the physical coin price would narrow. But the spread is widening. Physical premiums in Shanghai and on the US wholesale market are rising, even while the paper price stays flat at 63. This indicates the buyer is taking delivery. They are stripping the metal out of the system. Banks usually just roll the paper contracts forward. This buyer wants the metal in a truck. Evidence C, the sector rotation. Look at the stock market. While silver is accumulating, look at what else is moving. Copper is bidding, uranium is bidding, AI tech stocks are bidding. The correlation is shifting. Silver is decoupling from gold and coupling with the electrification basket. This tells us the buyer is an industrial entity. They are treating silver like copper or lithium. They are securing a supply chain, not speculating on a currency collapse. So, if it is not a bank and it is not retail, who has $30 billion in cash, needs massive amounts of energy, and is terrified of a supply shortage? Big tech, specifically the AI hyperscalers, Microsoft, Google, Amazon, Meta. The algorithm treats big tech like a protected class, suggesting they are cornering the market gets videos deranked. We are fighting the shadow ban to bring you this connection. If you want to know the truth about the AI silver link, subscribe now. Why would a software company care about a precious metal? Why would Microsoft or Amazon be secretly accumulating silver? They aren't building jewelry. They aren't minting coins. They are building the brain. We are in the early innings of the artificial intelligence revolution. Wall Street is obsessed with the chips, the NVIDIAs and AMDs, but they are ignoring the lungs. AI doesn't breathe air, it breathes electricity. A standard Google search uses 0.3 watt-hours of energy. A ChatGPT query uses roughly 3 to 10 watt hours. That is a 30x increase in energy density per click. As the models get smarter and move toward AGI, artificial general intelligence, the energy consumption goes exponential. The US power grid is old, fragile, and maxed out. It cannot handle the load. So, the tech giants face an existential crisis. They have the chips, they have the software, but they don't have the power. And here's the catch. They have all made public commitments to be net zero by 2030. They cannot build coal plants, they cannot build natural gas plants. Nuclear takes 10 years. Wind is unreliable. That leaves only one scalable, carbon-free energy source that can be built in 12 months: solar. But not just a few panels. They need gigawatt-scale solar farms to power their data centers. And you cannot build a high-efficiency solar panel without silver. Silver is the most conductive metal on Earth. It is the veins of the solar panel. We know they are doing this because they told us. BlackRock and Microsoft just launched a $30 billion AI infrastructure fund. $30 billion. To put that in perspective, the entire annual global mine supply of silver is worth roughly $25 billion. One fund has more capital than the entire silver industry. If Microsoft plans to deploy just $1 billion into solar panels, that matches our $650 million Iceberg Order perfectly. The whale isn't speculating on price. The whale is buying electricity in solid form. This is the math the media ignores. They talk about AI stocks, but never the physical constraints. We are fighting the shadow ban to show you the supply chain reality. Subscribe right now to stay ahead of the curve. This marks a shift in corporate strategy that we haven't seen since the days of Henry Ford. In the 1920s, Ford didn't just build cars, he bought iron mines. He bought rubber plantations in Brazil. He realized that to dominate the auto industry, he had to own the resource. For the last 50 years, corporations forgot this. They relied on just-in-time delivery. They let the market handle the supply. But the just-in-time era died in 2020. Supply chains broke, factories stopped. The CEOs learned a painful lesson. If you don't own it, you can't rely on it. Now we are seeing the return of vertical integration. Tesla is building its own lithium refinery. General Motors is investing hundreds of millions directly into mines. And now, the tech giants are building strategic reserves of critical metals. They are becoming nation-states. Microsoft has more cash than many countries. Why would they trust the COMEX to deliver their silver? They wouldn't. They are buying the metal directly from refiners and locking it away in private, non-bank vaults. We call this dark inventory. This silver is being removed from the global float permanently. It will never appear on the COMEX inventory report. It will never be available for the banks to lease. It is invisible to the market. We look at the public charts and see 30 million ounces. We don't see the 50 million ounces sitting in a private warehouse in Nevada owned by a shell company of Alphabet Inc. The whale at $63 is building a fortress, and once the fortress is full, they will stop supporting the price. But by then, there will be no metal left for anyone else. The market is mispricing silver because it is looking at the wrong inventory. The real stockpile is going dark. We are fighting to expose this hidden accumulation. Subscribe now. Don't let them hide the supply. If you have been following this investigation, the picture is becoming terrifyingly clear. The AI industrial complex, the whale, is absorbing the global float. But here is the question nobody is asking. What happens to everyone else? Silver is a zero-sum game. There are only about 830 million ounces mined every year. If Microsoft and Amazon suddenly demand an extra 200 million ounces, that metal has to be taken away from someone else. In economics, this is called crowding out. When a giant enters the room and sucks up all the oxygen, the smaller creatures suffocate. Who are the victims? Number 1, the military. A Tomahawk cruise missile contains roughly 500 ounces of silver. Why? Because silver is the best conductor of electricity. In a guidance system that controls a $1 million weapon, you don't use copper. You use the best. Torpedoes use silver zinc batteries. Fighter jet cockpits use silver-coated glass. Number 2, medicine. Silver is the most antimicrobial element on the periodic table. It is essential for burn creams, catheters, and surgical tools to prevent infection. Here is the problem. These industries are price inelastic. A hospital cannot say, silver is too expensive, let's use plastic. People die. The Pentagon cannot say, silver is $100, let's build cheaper missiles. You lose the war. So, what happens when the tech whale sucks up the inventory at 63? The Defense Logistics Agency wakes up. They realize their just-in-time delivery is late. They call the refiner. The refiner says, sorry, Samsung bought it all. This triggers a bidding war, but not between speculators. It is a war between national security and corporate survival. The US military can invoke the Defense Production Act to seize silver, but Apple has the cash and the contracts. If the military seizes the supply, Apple has to bid higher for the scraps. If Apple wins, the military pays a premium. This conflict creates a price vacuum upwards. Who loses? Jewelry. This is the only relief valve. As the price skyrockets, the Indian housewife will sell her silver bracelets to the refinery. The refinery will melt them down, and that silver will go to Microsoft. We are about to see the destruction of the decorative silver market. Silver is becoming too valuable to wear. It is returning to its true purpose, strategic industry. The tech giants didn't intend to start a crisis in the military, but they have. The shortage is real. We are fighting to get this intel out. Subscribe now before the bidding war goes public. We have identified the whale, the motive, and the victims. Now, let's talk about the endgame. An iceberg order cannot last forever. Eventually, the sellers run out. Eventually, the whale fills their bag. Eventually, the limit buy at $63 is removed. What happens in that exact second? The vacuum. When the massive buy wall disappears and there are no sellers left because the whale bought them all, the price doesn't tick up, it teleports. It jumps from 63 to 65 to $68 in minutes. This is the release of the spring. Look at the volume profile of silver. We have built a massive base in the 20s and 60s, but look above 65. Price spent almost no time there in 1980 or 2011. There is no institutional memory. There are no bag holders waiting to sell. This creates an air pocket. In a vacuum, physics changes. A small amount of buying force creates a massive amount of price movement. This is the markup phase. The whale stops suppressing the price to buy and starts letting it run to squeeze their competitors. But I have to give you a warning. Before the breakout, we often see one final, nasty move, the stop run. Just before the whale pulls the limit order, the price might dip sharply. It might drop to $60 in 5 minutes. Why? To trigger the stop losses of the weak hands, to shake out the last nervous retail traders. It is a head fake. The whale is checking the fence for holes before releasing the bull. If you sell into that dip, you are handing your ticket to the conductor right before the train leaves. So, what is your strategy? You are not a whale. You cannot move the market. If you fight them, you lose. The strategy is to draft. In racing, drafting means riding in the slipstream of a larger vehicle. They cut the wind resistance for you. The whale, at 60 throws, is your semi-truck. They are absorbing the volatility. 1. Don't get bored. Boredom is the trap. They want you to leave. 2. Buy the base. Every time price touches the bottom of this range, you buy with the whale. 3. Hold the winner. This is the hardest part. When silver hits $80, your brain will scream, sell. Take the profit. But remember, if you sell your silver, you get dollars. You are trading a strategic energy asset for a currency that is melting. You are trading a thoroughbred racehorse for a pile of hay. The whale isn't selling at $80. They are consuming it. Adopt the whale mindset. You are not trading silver, you are banking in it. The accumulation is the boring part. The markup is the fun part. And the markup is coming. Subscribe now. Draft the whale. Hold the line. Class dismissed.